Thank you for taking the time to join us in this Money Chat series. My name is Ibrahim Sani. We're doing a three-parter series where we are going to be talking about the global market outlook, Asia market outlook, and of course, the Malaysia market outlook. We're going to start with the global market outlook with a good friend of ours, Dr. Sailesh Kumar Jha, the Chief Economist and Head of Market Research at RHB Group. Dr. Jha, thanks for taking the time to speak with us. Let's do a quick stock take in terms of how 2022 was a difficult year, and not just for equity, but fixed income assets as well. All of them have come down. The client's investment portfolio and asset allocation was also distorted while investors are looking to reassess their investment holdings. Perhaps you can walk through with us some of the ideas that RHB Bank has when it comes to the 2023 view on global asset allocation. Dr. Jha.
Yeah, hi, good afternoon. I'm over in India, and thank you. Good to see you again. We just published our report literally on Thursday morning, right after the Fed FOMC meeting. So we took into consideration what the Fed has to say. Nothing new for us. It was very much in line with what we're expecting. And our core view, let me walk you through it in a bit, is our global asset allocation for 2023 is overweight equities, market weight fixed income, underweight cash. And the title of our report is that recession fears are overdone. We are bullish on the outlook for 2023. The main themes that investors will be focusing on in 2023 will be the path of U.S. growth, the path of the U.S. dollar, and third, the dynamics of the China reopening. On the U.S. growth path, we have been firmly in the camp since summer 2022 that the U.S. economy would avoid a recession in 2023, and that we're just in the midst of a slowdown to trend in first half of 2023, and then followed by a recovery in the second half of 2023. This is a counter-consensus view, very counter-consensus, where we're looking at 2.2% GDP growth in the U.S. in 2022 versus market expectations of 1.8%. The market had essentially in summer downgraded U.S. GDP growth to 1.5%. And for next year, the market's looking at 0.4%, and we're looking for 2%. So keep in mind that the sell-side community, as well as investors, have been pushing out the recession view. The first was like, oh, it's coming in 2023. Now it didn't happen. So it's pushed to 2023 and to 2024. It's like thinking about a recession that's not going to come. That's our core view. All right. So good growth is good for equities, right? Very simple, right? And also, we're thinking that the peak of the Fed hiking cycle will be happening in the first quarter of 2023. Inflation momentum is coming down. All very good for risky assets. And so it means equities in this environment outperform bonds and cash. The other thing that is positive is, from our perspective, that the dollar is set to basically weaken in the second half of next year. We've been dollar bulls, probably one of the few people in the market since December 2020. So we're talking about a good 2 years later, we're now turning in terms of our view on the dollar. Dollar got a little bit more weakness, strength to go in the first quarter of 2023, but the trend is going to be our friend, meaning the dollar is going to depreciate against Asian currencies in the second half of the year. So the key message to everybody is the peak of dollar strength is over. We got a little bit more strength in the first quarter, but not like what we've been seeing in the second half of this year. In terms of China, this has been a big deal for everybody, right? Because so many institutional portfolios, so many retail portfolios, so many private banking, ultra high net worth portfolios have been skewed towards China. And we remain firmly in the camp. We've been bearish on China for 2 years. Ever since I joined the firm, it's been a bearish view.
On top of China, we need to talk about the US right now, because in your December Global Economics and Market Strategy report, you continue to reiterate again that the US is unlikely to go into a recession for 2022 and 2023. This is generally a bold statement and largely against many of the other FI's view and basically consensus view. So perhaps you can share with us some of the ideas to reiterate again your key salient points from the perspective of your in-house view on why is unlikely to head into a recession for 23.
Yep. No, that's a very good point, and I just have to be, humble and say it's really not that bold, because what we do is think through the data and the analytics. That's what we do. We let the data tell the story, the analysis tell the story. Now, the key conclusion from an investment perspective is that some U.S. equity markets are going to deliver returns in 2023 of 10 to 15%. And we're referring to essentially the Dow Jones Industrial Average Index. Now, in this part of the market cycle, we have to distinguish which index are you talking about? Is it the Dow Jones? Is it the S&P? Is it the NASDAQ? We are most bullish on the Dow Jones Industrial Average Index because it is like old economy, very, how shall I say, bricks and mortar, things where earnings are so visible. They're not super contaminated by interest rates. They're not super contaminated that much by the dynamics of inflation. These are very good companies. So we essentially want to be a little bit boring, but boring in the new world is 10 to 15% for us. Okay. Why are we so adamant and have been adamant since summer that the US is not going into recession? And the reason why our view is different from analysts and the central banks' view around the world about the U.S. Is that, a couple of things really. What we're observing is that the tightening of monetary policy in the United States, which literally started being priced in by the financial markets since end of 2021, early 2022, most of it has already worked its way through the system. That's why you notice that in the first half of 2022, the U.S. actually went into a technical recession. Very few people talk about that. It already went into a technical recession and then it's bounced back. All right. So basically on a year-on-year basis, I'm talking about on a year-on-year basis, the U.S. has bounced back to like 1.8% GDP growth in the third quarter. And analysts are looking for U.S. growth to slow to 0.4% in the fourth quarter, which is essentially what I would call being in la-la land. The U.S. economy actually is most likely to accelerate in the fourth quarter of the year. We're likely to print like 1.4 to 1.9% as a very conservative estimate. For us to get to our 2.2% GDP growth back is pure math. And looking at RHB's proprietary data, when we're looking at the micro level data, looking at satellite images of U.S. economy, truck stops activity, logistics sector activity, not all that boring stuff like ISM and geopolitical. Who cares? Everybody's got that. And as of basically early December, that's showing such a nice resiliency path. Okay. The second aspect is, like I said, the main point is that the tightening of monetary policy is already pretty much digested in the system through markets, through into the economy. Any further tightening of monetary policy, which we're expecting, the Fed's going to go to 5 to 5.25%. That's why I told you when the Fed essentially did their meeting and announced, we were like, I'm sleepy, simply because it's something that had been orating coming into the meeting anyway, right? Why the market is selling off? As you know, seeing is believing. Market was pricing in that perhaps the Fed was going to take a little bit of a dovish tilt, and it simply didn't happen, right? 5 to 5.25% from where we are today is not that far away. So the so-called digestion of future tightening of monetary policy will happen in the first half of next year. And from the second half of next year, we're essentially looking for recovery in the U.S. The second point is keeping this in mind. And it's a very, as you say, a salient point. And you notice this in our home base in Malaysia as well. The gig economy. Why are U.S. workers, why is the participation rate falling? Think about it. If U.S. growth is so good, why is the participation rate in the U.S. labor market falling? It's very simple. It's simply because you have the gig economy You have essentially online type of stuff, which is part of the gig economy. People have opportunities, other opportunities. They don't have to wear like a fancy suit and tie like you and me. I'm on vacation, so I can not wear a suit and tie. But bottom line is, they don't need to do that, right? They can just work whenever they feel like. And it's funny, when you do anecdotal surveys, both in the US and you think about it in home-based Malaysia, some people are actually able to make more money than when they do some kind of corporate or banking job. So this is what is so underappreciated by analysts and policymakers. The third main point is we have to be very careful. Coming into this cycle, not only was there, a lot of loose fiscal policy, a lot of loose monetary policy, people talk about that all the time, right? But what is really underemphasized is that the U.S. consumer, besides getting the benefits from loose fiscal policy, loose monetary policy, came into this cycle in fantastic shape because they paid down their debt, and similarly with consumers, so very, very strong consumer and corporate balance sheets, and overlaid. You have to talk about this balance sheet effect overlaid with essentially so much opportunities in the U.S. Labor market, right? So the bottom line is it's extremely difficult for the U.S. to go into any recession, at least in the forecasting time horizon in 2023. And we believe what will happen is in the first half of 2023, the market will come to our view. People will be raising their forecasts. The economic data will be surprising on the upside, where people are looking for maybe a recession in the first half, maybe second half. And basically what that will do is super positive for U.S. equity markets from our perspective.
There's this whole notion of being not bearish versus being bullish. You saying that U.S. not going into recession, I would argue that is not bearish, but you're actually bullish in the sense that you've shared that for U.S. equity for 2023, the potential upside can go up to 15%. And the thing is, we don't know the terminal rate of U.S. Fed hike with the monetary policy is still ongoing. The Russian-Ukraine war, for instance, is still ongoing. Some, nagging issues of supply chain is still ongoing. There's so many things, macro factors, as well as geopolitical tensions that are still happening. Do share with us perhaps why you feel that the catalyst for getting the 15% or potential upside up to 15% is possible for U.S. equities, Dr. Jha.
The possibilities are, as I just talked about, the first factor. You are very kind to navigate me through the other two factors, why we're bullish, is growth, right? Investors' expectation, you'll see it in the front page. When we look at the surveys of what investors are thinking about the 6-month forward-looking from a view on growth, it's of a collapse. So see how the market is positioned, meaning sentiment is so weak. Any marginal upside surprise is going to turn that sentiment. We believe investors, forget the analyst community, right? We don't invest the money, right? Directly, right? We're just giving our view. But the investor community, exceedingly bearish. The positioning is of bearish sentiment. So on the inflation front, we are of the view that, a little bit more challenges, not too much, but by the time we get to the second quarter of the year, it'll become increasingly clearer, or crystal clear, really, that the inflation target of the Fed, we're going to get there sometime in the second half of the year. We're penciled in August, but realistically, it's really hard to pencil in every, what particular month. But let's just put it in the second half of the year, right? Yeah. So inflation, the 2% target is going to be met sometime in August, second half of the year, put that in. The Ukraine-Russia related risk have completely dissipated. It's like, below $80 per barrel on Brent. Who would have thought? We thought it was going to come off to like around 80. Even us internally, that's what my team was thinking. It's come down below $80 per barrel. So where is this, Russia-Ukraine risk manifesting itself? I don't see it. Food prices have come down. Commodity prices are pretty much down, and it's fabulous. I think the Western Alliance has to be very careful when they're thinking about the Russia aspect. Is that it's actually helping them right now, right? Commodity prices have completely come off. It's helping them on the fight for inflation, helping them on the keeping growth resilient and making their life actually less complicated, quite perverse, if you ask.
Dr. Jha, let's take a look into the wider lens of the global equities scene, moving away from the US. Within the global equity market, do you have any preference towards any investment style or sector? For example, how would you allocate your assets between growth and value stocks? What are the sectors that you like, particularly heading into 2023?
So all I can tell you at my level, right, is remember that my team basically gives the big picture as far as particular asset classes go.
Yeah.
So in the equities world, the trade is the following. We'll start at the very big picture at geography. So it's good to get the geographical allocation correct, right? So our top pick, as you can surmise, is the US, okay? Followed by essentially Southeast Asia, where we think it's going to remain resilient, precisely because of the uncertainties you mentioned quite eloquently, defensive in nature, all cool, right? And in North Asia, we will continue to advocate selling China on any rally and buying India. Given that our outlook on growth is bullish, meaning second half recovery in the second half of the year, it's natural for us to be on a relative value basis, be from a balance of risk perspective, more optimistic on growth versus value. When growth, meaning economic activity picks up, the relative strength of growth will outperform value from a balance of risk perspective. That's how we would think about investing.
And of course, maybe you could give your insights a little bit more in terms of the dollar index spot or DXY, because the US dollar has been bullish since December 2020. Where do you see the dollar index or DXY heading towards this year, 2023? And what is the investment strategy that investors perhaps can look into riding on your view on the DXY trend?
Right. So I'm just getting out of here. I forget the exact point estimates, but let me give it to you right now while you were speaking.
Sure.
Thank you for giving me that time. So we've been bullish on the dollar since December 2020. We've faced the pressure all the way through last 2 years. Okay. So now we're giving the idea now that because in the first quarter of the year, so let me talk about the trajectory, right? Because we have to talk about the trajectory and then get to the end year, how that's going to manifest itself in terms of the DXY index. We think that we're going to get a bit of dollar strength in the first quarter of the year, right? 105 to 110 is the range, right? Not too bad, not too shabby, because we had traded at high as 114, right? And the main reason is precisely that the U.S. equity market will weaken. Orders of magnitude of sell-off of 5 to 10%, I don't think it's really a big deal, right? Some people may think it's a big deal, but it is kind of something that is in the norm of possibilities, and it's happened even in the second half of the year, if you recall, right? So in our model, ours is a model-driven thing, right? We believe, as the good friends in America say, talk is cheap. So from our models, what we find is that the key drivers of a strengthening of dollar from current level, not too much. We're currently trading around 104 and change. Well, not currently, it's closed today, but on Friday night, I'll go to 105, 110, precisely because the U.S. equity market is going to sell off, right? That risk-off sentiment is good for the dollar. The second aspect, as I mentioned earlier, is that we need, the market will be pricing out the rate cuts for the second half of the year. And that is definitely dollar positive. These are two main factors that are going to drive the dollar strength a little bit to 105 to 110. By the year end, we should be at 98 to 103. And the main reason there is that, as I mentioned earlier, on the top-down macro front, growth is looking good, meaning growth will be rebounded, risk-on sentiment, positive for equities, is negative for dollar. And then what will be also happening is that the interest rate differential will be basically less compelling towards holding dollars versus Asian currencies. And those are basically the two main factors as we head towards year end that will lead to a weaker dollar against Asian currencies. Note that I'm being nuanced. Now the world is going to be much more driven by domestic factors into the currency, right? All the way through, like this year, has been a dollar story, some story with a relative, in relation to some domestic factors, but it's mainly left-hand side of a currency pair. As you all know better than I, the currency is a pair. So you have to know both the drivers on the left-hand side and the right side of the pair. We have been paying completely everybody, and I don't disagree completely, to the left-hand side, the dollar. Now, domestic factors, how is it going to work out, towards year end?
Most of our questions are focusing on the global economy and the global equity market. And interestingly enough, as you alluded to earlier, that you're joining us all the way from India. And I read with interest your view on India. Perhaps it's good to share with some of our friends who's joining us in this conversation to know or hear directly from you what would be the catalyst and the challenges that might persist or might be present in terms of investing in India, Dr. Jha.
I think one of the challenges for international investors for investing in India always has been having direct access at the shares level, not at the mutual funds or funds level, to accessing the Indian equity market. So you're kind of like forced to investing in mutual funds or in the ETFs. That's the big challenge. But regardless, because these funds and ETFs track the index in any event, whatever Indian equity index you want to look at the performance of Indian equity market year to date, right? We're down by about 6%. China's down by about 22%, despite the rally in the fourth quarter of the year. This is looking at even though Indian rupee has depreciated big. Keeping that in mind, this is dollar to dollar, not basically local currency, right? The reason why we've continued to favor India for the last 2 years is three main things. One is that India doesn't suffer the geopolitical risks that China does. That's a big deal, right? Despite what the U.S. and Western alliance may narrate to India that stop helping the Russians, stop helping Russians, it really doesn't impact them much. Point of one. Second, India is still a relatively, I would say, more domestic-oriented economy, very limited linkages to trade, where China, on the other hand, 55% of consumer spending is let's say, driven by the export sector. All that means in plain English, 55% of the consumers in China, when they buy stuff, their income is coming from the export-oriented sectors. Two, the third is that when you think about the policy direction, whether it's fiscal, whether it's monetary, exchange rate policy, it's all crystal clear. Whereas in China, we have absolutely no idea where it's headed, particularly as it relates to debt. India has high debt, don't get me wrong, right? But not the type of issues in the plumbing as to where the debt resides, like in China.
Dr. Jha, it's very refreshing to hear somebody that is quite bullish in your views, and I think we really need more voices like you. And of course, some of the comments that you said is easily evidenced by data, so it's not necessarily your own opinion. You're basically driving data moving forward and just concluding or presenting some sort of hypothesis on what the data is. That was Dr. Sailesh Kumar Jha, the Chief Economist and Head of Market Research at RHB Banking Group. This is, of course, part of a series that RHB is doing when it comes to Money Chat series. We're talking right now the year-end 2022 global market outlook and 2023 market outlook for the global market. There's also many more that is in this series as well, including the Asia market outlook, as well as the Malaysia market outlook that is going to be presented by some of our friends over at RHB Group. But for now, that was our conversation with Dr. Sailesh Jha on the global market outlook. Dr. Jha, final word before we conclude our conversation?
The final word is, don't worry, be happy.
Fantastic. Also, it's a new year, and many of us are now dragged back into the office. So yeah, that is something that we really need to hold on tight to. Don't worry, be happy. Thank you very much, Dr. Jha, and to our friends joining us in this conversation. Thank you for joining us.
Thank you for having me. Appreciate it.